Well, we started because the owner of the company did title curative work for banks. We already had an inside track to their trade desk. So our first tape of 12 REOs came from a bank. Now, when we went off into contract for deeds, because we didn't have, you have to have so much capital to be able to buy from a bank. And when you're not hitting the $10 million mark or more, you have to look elsewhere. You have to think outside the box. So we hit the smaller funds, a contract for deed. Contract for deeds, really, really, really need to know the law in each state because it varies, and it's not like a traditional non-performing note. So, and by the time we were done, so we had 26,000 assets, 70% were non-performing. 28% were performing. The other 2% were REOs, and those were NPLs that we held. We really didn't buy REOs except for that first pool and then the contract for deeds. REOs are hard to come by at a discount. They really have to be title defective for it to be worth your money to buy them, unless you're going to do a long-term strategy. Investor covenants will guide and govern what you can do with those assets. For example, we had some fabulous assets that would have been turnkey, and they were already turnkey, but we couldn't use them as turnkey rentals. That wasn't in our covenants.